Hello and welcome to 5-Year Club video number 227. Today we're going to be talking about the Real Estate Investment Trust. Why? Well, at lunch somebody brought up, what do you think of real estate investing? And I told them my spiel, which is your primary residence is not an investment. And if you're going to invest in a rental property, I think you need to try to get a deal on it. You need to try to save, say get it 20 or 30% below the market value. So you could flip it immediately without doing much if you wanted to. And also you need to put at least 50% down. You need to have, you need to not get upside down on a property that you're just trying to get some cash flow out of. Also that cash flow, you need to make 12% on your money because 5% of that 12 is likely going to be, devoured by, random stuff like, vacancy, the time in between renters or something like that. And, 12% minus 5%, you're down to 7%. If you're only going to get a 7% return on an investment, you might as well be in the stock market. And you have some exposure to real estate when you're in the stock market because those companies own real estate. So anyway, that was the spiel I gave. But I did mention there is such a thing as a real estate investment trust if you want exposure to real estate, but you don't want to deal with actually dealing with a physical property. However, I don't know much about real estate investment trusts, so I thought tonight was a great night to talk about them, to at least read through a couple articles on them, get a little bit more knowledge, and now, we've done that. So in the context of this channel, this is one of those videos where it's like Lewis is going to sit and hold your hand as we read through a boring article that you otherwise would ignore to watch Cops. No, that's me projecting my love of Cops onto you. To watch The Bachelorette. Who knows? The Bachelor. What's Grey's Anatomy? There's a classy one. All right. Let's do it. So I've got these two articles from Investopedia. The first one is an overview of real estate investment trusts and some of the legal guidelines to qualify. And the other one is from Money US News Money section. And it is titled The 10 Best REIT ETFs. So that would be Real Estate Investment Trust Exchange Traded Funds on the market. Do I believe that these 10 that they're going to cover are the best real estate investment trust exchange traded funds? Well, maybe if they're doing it by some measure of return, I guess you could technically say they picked the top ones. I don't know. I tend to not trust these kinds of articles. I tend to think that that any kind of stock or whatever that's hyped by an article is likely already oversubscribed, and that's not where the opportunity is. But hey, what do I know? Maybe they've got an article on VTI in the U.S. News Money section, and VTI is a great ETF of an index fund, turns out. All right, let's go. Real Estate Investment Trust, REIT. What is a real estate investment trust? A real estate investment trust, or REIT, is a company that owns, operates, or finances income-producing real estate. For a company to qualify as a REIT, it must meet certain regulatory guidelines. REITs often trade on major exchanges like other securities and provide investors with a liquid stake in real estate. Breaking down real estate investment trust. REITs are not a new financial innovation established by Congress in 1960 as an amendment to the cigar excise tax extension of 1960. Well, that sounds exciting. REITs operate in a manner comparable to mutual funds as they allow for individual investors to acquire ownership in commercial real estate portfolios that receive income from properties such as apartment complexes, hospitals, office buildings, timberland, warehouses, hotels, and shopping malls. Most REITs specialize in a specific real estate sector, for example, office REITs or healthcare REITs. Within this space, REITs must purchase and operate its holdings as part of its portfolio. In most cases, REITs operate by leasing space and passing on collected rent payments to its investors in the form of dividends. REIT guidelines. So this is notable. So you're paying a tax on dividends. It's going to be a dividend tax, which, by the way, is not very good if they're not qualified. A company must meet the following requirements to be qualified as a REIT. Invest at least 75% of its total assets in real estate, cash, or U.S. Treasuries. receive at minimum 75% of its gross income from rents from real property, interest on mortgages financing real property, or from sales of real estate. Okay, so REITs make income from selling real estate, from charging rent, and from mortgaging, from providing mortgages, so they receive interest. Interesting. I didn't know that they were in the mortgage game, but apparently that's true. Pay a minimum of 90% of its taxable income in the form of shareholder dividends each year. This is interesting because if you think about like what would be a REIT that would rip you off, right? It would be a REIT that's not passing on its rents to you. But this is 90% of taxable income, not rents. So if they can kind of receive a bunch of rent and then spend that rental income on things that are considered tax write-offs and somehow pay themselves with things that are tax write-offs, I don't know. When I say pay themselves, I mean the people who own this company, they're paying themselves and calling it a tax write-off. Then that money is going to them. It's not going to you because the tax write-off is not considered taxable income. So it doesn't count towards that 90% of taxable income. Be an entity that is taxable as a corporation, be managed by a board of directors or trustees, have a minimum of 100 shareholders, have no more than 50% of its shares held by 5 or fewer individuals. Different REIT categories. REITs typically fall within 3 categories. Most REITs are equity REITs. Equity REITs invest in and own income-producing real estate properties and give investors the opportunity to invest in these portfolios. They must distribute at least 90% of their portfolio's income to its shareholders in the form of dividends. Mortgage REITs invest in and own property mortgages. These REITs loan money to real estate owners and operators, not only for mortgages, but also for different types of real estate loans, or through purchasing mortgage-backed securities. These were the complicated things that screwed us in 2008. Their earnings are generated primarily by the net interest margin, the spread between the interest they earn on mortgage loans and the cost of funding these loans. This model makes them potentially sensitive to interest rate increases. Hybrid REITs invest in both properties and mortgages. All right, so, why are you sensitive to interest rate increases? Well, for one, if interest rates go up and you're holding a mortgage that's at a lower interest rate, it's not a very attractive mortgage to own anymore. And so if you sell it to some other REIT, they're not going to want to pay as much for it because they could just get a mortgage on the open market that has a higher interest rate. Now, if interest rates increase, that also is going to increase the borrowing costs for the REIT, because the REIT's going to borrow money, I guess, and then pay that money potentially to, that's what banks do. They borrow money from the Fed at whatever the federal interest rate is, and they loan that money out to people. Anyway, yeah, that's going to increase the cost of purchasing a mortgage from a bank, for example, if you're a REIT. Okay, this is just me thinking through how interest rates affect REITs. I'm not an expert on it. All right, how to invest in REITs. Individuals can invest in REITs either by purchasing their shares directly on an open exchange or by investing in a mutual fund that specializes in public real estate. Some REITs are SEC registered in public but not listed on an exchange. Others are private. Many REITs will invest specifically in one area of real estate, shopping malls, for example, or in one specific region, state, or country. Others are more diversified. There are several REIT ETFs available, most of which have fairly low expense ratios. The ETF format can help investors avoid overdependence on one company, geography, area, or industry. All right, so that is a good overview of REITs. We've got some information about what they are, about what they aren't. We know they have to pay 90% of its taxable income, but we don't know exactly what can, decrease that taxable income. So, I'm definitely I'm a suspicious person. I'm a skeptical person. So it'd be nice to know some about that later. Perhaps in a different video, I will try to specifically look up rip-off REITs, which is not an official thing. It's something I just made up. But if I learn what's a rip-off, then I can learn what to avoid. All right, the 10 best REIT ETFs on the market. I am not saying these are the best ETFs on the market. I'm simply going to read through them because they will give us some examples of real estate investment trust exchange traded funds, and then we will have an idea of even what's available. If you want a simpler way to invest in real estate than owning rental property or flipping houses, investors should look to real estate investment trusts, or REITs. These trusts invest in real estate either through direct ownership of properties or by buying mortgages and other mortgage-related securities. However, REITs play in a number of areas, from retail to healthcare to residential, so investors are best served trading the sector broadly. But what blend makes the most sense? We'll explore this by looking at 10 of the best REIT ETF options to buy today. All right. Number 10, Van Eck Vector's Mortgage REIT Income ETF. Mort invests in mortgage REITs. These REITs borrow money to invest in mortgages or mortgage-backed securities and make money off the spread in interest rates. Mort invests in 26 such IM-REITs with a heavy overweight in Annaly Capital Management and AGNC Investment Corp., which make up a combined 22% of the fund. Like all REITs, IM-REITs must pay out at least 90% of their taxable income on dividends. Expense ratios 0.41. For comparison, the expense ratio of a Vanguard index fund is going to be 0.04 or 0.05, so 10 times less. So, yeah. However, dividend yield 10.4%. That's a pretty high dividend yield. 10% is pretty good. This may not last in a down economy, but 10% is not bad. The stock market will also do 10%, FYI. It's also not clear to me if, I guess this doesn't include, this does include inflation. In other words, if you said that there was 3% inflation, this return would actually be only 7.4%, maybe. I'm not sure. Number 9, iShares Residential Real Estate Capped ETF. RES invests in equity REITs, trusts that actually own and operate real estate properties. RES's name implies that it invests in residential-focused companies, and it does, but it also holds healthcare and self-storage trusts as well. In fact, self-storage REIT Public Storage, PSA, is the top holding at roughly 10% of the fund, followed by apartment REITs, Avalon Bay Communities, and Equity Residential. Those two yield 3.7% and 3.6%, respectively. Expenses 0.48%. iShares U.S. Real Estate ETF. IYR invests in a wide blend of 124 U.S.-based REITs. Not only does IYR have more holdings than Mort and RES, but it also covers more areas of the REIT world, including retail, residential, office, healthcare, and even some IM-REITs, and it's less top-heavy than the other two funds. Communications REIT American Tower Corp., AMT, is the top holding at roughly 6%, followed by a mall operator Simon Property Group, SPG, and another communications REIT Crown Castle International at 4.9% and 4.2% respectively. I guess top heavy means their top holdings, how much of them is held by their top holding. All right, but we actually don't have a breakdown of how many properties or whatever are in these AMT, SPG, CCI. So, yeah, we're not actually sure how that risk is spread. It's obfuscated. Expenses 0.44%. PowerShares KBW Premium Yield Equity REIT Portfolio, KBWY. Sounds like a radio station. While REITs in general are a high-yielding asset class, higher even than stocks in the 1998 through 2017 period, the KBWY looks to maximize that by investing in some of the market's highest-yielding equity REITs. This is the best of the best. The top investments among the mere 30 stocks in KBWY include Global Net Lease, constituting 5.8% of the portfolio and yielding 12.1%, and Washington Prime Group, WPG, constituting 5.7% of the portfolio and yielding 16.7%. Expenses 0.35%. It's interesting to me that they have that lower expense ratio, but their overall dividend yield is less than what we saw before. I would be interested to know and understand how the actual cost of the exchange traded fund, how the cost of that, fund impacts your net worth in the fund. In other words, how much of the money that you make from holding PowerShares KBW is due to an increase in the price at which you can sell your shares versus being due to the dividend yield that you receive from it. I don't know the answer to that. Number 6, iShares Cohen and Steers REIT ETF, ICF. Next among the best REIT ETFs in the market is ICF, a diversified fund that invests in 30 trusts considered to be the largest and most dominant in their respective property sectors. Specialized trusts, retail trusts, and residential REITs each constitute around 20% of the fund. Top holdings aren't too surprising, featuring big REIT names Prologis and Simon Properties, which I guess is that mall thing that was mentioned before, as well as data center REIT Equinix, EQIX, but the yield is one of the lowest of the best REITs. Okay, so it says their yield is crap, and their yield is 3.4%, which is not very good. Number 5, Vanguard REIT ETF. I actually suspect that I might hold this. I think I might hold this in Betterment, but I'm not sure. Vanguard brings its special brand of low-cost diversified exposure to the REIT world via the VNQ, which immediately stands out with its dirt-cheap expense ratios and exposure to 184 U.S. REITs that cover a wide swath of the real estate space. Specialized REITs make up nearly 25% of the fund, with residential, office, retail, and healthcare trusts all receiving double-digit weightings. Top holdings include SPG, PLD, and Equix. So these are the same ones that I mentioned before. So if you want to hold the same underlying stuff that these other guys are holding, SPG, right, and the data center one, like I said, Simon Property Group, the same mall stuff we've been talking before, you can either pay 0.44, 0.48, or what we were discussing before, or you can go with Vanguard and pay 0.12, pay 1/4. Have a 75% discount. You're holding exactly the same underlying assets. This is why people like Vanguard. It's not a mystery. Dividend yield is obviously not that great. I don't know what to say there because I'm not that familiar with the underlying numbers. Would be very interesting to check what is the lifetime return of VNQ versus because this dividend yield is probably the instantaneous dividend yield or the dividend yield last quarter. I'm not sure. But it would be interesting to see over the entire lifetime of VNQ, what is the return? Over the entire lifetime of IYR, or one of these others that we've discussed, what is the return? Number 4, SPDR Dow Jones REIT ETF. The RWR is yet another broad-based U.S. REIT ETF, though the price of this one depends a bit more heavily on its top stock holdings. SPG makes up nearly 8% of the fund, Prologis nearly 6%, Public Storage almost 5%, and Avalon Bay nearly 4%. Here, industrial office-focused trusts have about 29% exposure, residential is second at 21%, and retail also gets double-digit exposure at 19%, as an expense ratio of 0.25 and a dividend yield of 3.2%. Number 3, First Trust S&P REIT Index Fund, FRI. The FRI is built in a similar vein to VNQ, holding a fairly diversified blend of real estate investment trusts and featuring retail at just under 20% of the fund. FRI is slightly less diverse at 160 holdings to VNQ's 184, but its top 10 holdings compose 33% of the total portfolio compared to VNQ's 37%. Top holdings will sound familiar: Simon Property Group, Prologis, and Public Storage. Expenses 0.49%. So way more expensive than VNQ. Dividend yield 2.8%, worse than VNQ. Number 2, iShares Global REIT ETF. If you're looking for international exposure, REET is one of the best REITs you can buy, though it's not heavily global considering US REITs still make up more than 60% of the fund. The rest of REIT's geography weight is thick in developed markets, with Japan and Australia at roughly 7% weightings and the UK at 6%. Top holdings are dominated by U.S. REITs too, including SPG and PLD. The only internationals in the top 10 are France's Unibail Rodamco, and Hong Kong's Link Real Estate Investment Trust. Expenses 0.14%, so higher than Vanguard, but only by a little. Dividend yield 4.1%, lower than Vanguard, but was Vanguard 4.8%? 4.1% is like, all right. I'll think about it. Number 1, Schwab US REIT ETF. In many ways, Schwab's SCHH isn't terribly different from many of the other blended REIT offerings on this list, stacking SPG, PSA, and PLD up at the top, and offering large weights in retail, residential, and specialty real estate. However, SCHH has all other REIT ETFs beat in one respect: expenses that would win any limbo contest. So this Schwab US REIT is only 0.07%, the expense ratio, but the dividend yield is 2.8%. Now think about what this means. It means that you're making 2.8%, but they're taking from you 0.07%. So it's kind of like, well, your problem here might be that you're not making 10%. You're missing out on 7%. Not that your expense ratio is like, 0.05% lower than Vanguard's. I'm not saying that Vanguard's at 10%. Just to clarify, all I'm saying is that once you get it looks like about 0.15% in terms of your expense ratio on these things. Your expense ratio is not your problem anymore. It is the yield, the actual return of the REIT. And since I don't have a good giant list of REITs and what their returns are over a long period of time, and I don't have an in-depth knowledge on the structure of these things and what's a fair structure and what's an unfair structure, I can't speak to what we should be investigating inside these REITs to really compare them well. All I can say is that it looks like the dividend yield is making a much bigger difference in people's investment outcomes in these REITs than the expense ratio. Because some of these dividend yields were closer to 10 and some of them are closer to 3. And that's a big difference, especially if it is over a long period of time. It's a huge difference if you're talking about a 10% return versus a 3% return over 20 years. Okie dokie. Well, that is it for 5-Year Club video number 227. I hope you enjoyed it as much as you can enjoy listing about 10 random REITs with these random letters. I hope you know a little bit more about REITs. In summary, they are funds that invest in rental income for the most part, mortgages somewhat, and they can also make money from selling properties. So they can do that. And they're involved in all different dimensions of the real estate market: residential, office, healthcare, commercial, chicken, sugar fat. Nope, that's not actually an area of real estate. That's just kind of the name of a dinner that I want to make someday. Chicken, sugar fat. Who wouldn't want that? All right. Well, that is it for 5-Year Club video number 227. Have a fabulous evening.